Welcome to WealthShield's High Efficiency Domestic Growth Portfolios. We are really excited about bringing these computer-based modeling platforms to the public. Up until now, all of our portfolios have only been for accredited investors through our wealth management practice. We believe this will bring a new opportunity to deliver knowledge, experience, and resources for our new and existing clients. We welcome you to take a look at what your investment portfolio could look like now and in the future. Thank you for watching, and we hope to be of service to you real soon. One of the biggest challenges in asset management are assets that don't perform, or worse, you know won't perform, but it's necessary to invest for various reasons. What we set out to do 2 decades ago is to come up with a systematic computer-based algorithm to not only weed out what we don't want, but to identify and isolate the great picks. I believe our 4 phases of the selection process allows us to be in control of the assets we collect for our portfolios. Here's a brief overview of our process. We start with the financial statements from over 16,000 different companies, and we scrub them with specific financial metrics. This is the weed out portion. It is important to note that we do not utilize any third-party or outside vendors who have opinions or their own quantitative metric system. So after we scrubbed out a large portion of the companies, we will use what-if scenarios and algorithmic weighted scales to measure companies utilizing quantitative measurements. It is also important to note that using what-if scenarios does not automatically kick out a stock like filtering does. For example, let's say you only want stocks that have less than a 20% price to earnings ratio because you're thinking, I don't want to overpay for a stock. So by using that filter, you automatically cut out every stock with a higher than 20% PE. What if they have projected earnings going through the roof or a huge free cash flow ratio? It is important to note that the quarterly growth portfolio still has quantitative measurements, but they will have different parameters than the other 2 portfolios, and technical analysis will have more influence on either weeding out or spotlighting a great stock. Lastly, the fluid risk assessment score will have a higher minimum with no maximum for a quarterly portfolio, since time is our stopgap measure, bringing the overall risk down. We will detail each of the 4 phases on the next few slides. As stated previously, our first step is to scrub out our list of companies down to a few thousand, where we can take a deeper dive into companies' financial data. Quantitatively, we can use real numbers in specific ways to weed out and handpick stocks. We ultimately use a synergy of GAAP, finance, banking, and actuarial sciences to cultivate a group of stocks to enter our next phase, qualitative measurements. Now, qualitative is hard to use because these are normally events, feelings, or sensations that cannot be measured objectively. Market conditions, social engineering, and cultural influences can actually be assigned factors and be very helpful in identifying opportunities for growth. The first 2 phases are a great way of showing what a company has done in the past, how it generates income, uses that income, and what it plans on in the future. Technical analysis is a hands-on approach to the trading markets for each stock. Depending on the length of time in the portfolio, will dictate how much emphasis is put on technical analysis, as well as the type used to bring forward the best opportunities. We are not day traders, but we would be remiss if we didn't include the buyer-seller relationship and how it directly moves the pricing of an asset, regardless of what we think about the company's fundamentals. Technical analysis plays more of a key role in quarterly portfolios than in longer-term portfolios. Countless hours of research, data input, and testing have gone into the algorithms that generate the fluid risk assessment matrix. This is the final phase of our process in creating high-efficiency portfolios. By understanding that risk levels move along with the price of an asset, we can then harness that risk level and control what we have in our portfolios. So when we want a conservative portfolio, we can truly hold investments that do not have much variance and produces a consistent conservative return. Too many times investors have bought a conservative portfolio only to immediately watch it lose 10%. What gets worse is that the advice from who they bought it from is, just wait, hold on, the market will come back. Investing is for the long haul. Sound familiar? Or the contrary, the investor watches their so-called growth portfolio lie flat while all they are hearing is that the market's going up. With our proprietary fluid risk assessment, we do not need time because we will be ahead of the curve. And what makes it even better is that one of our subscribers getting a financial plan using our software, then the subscriber's own risk score is part of the algorithm. So stocks and bonds risk scores will be reflected in how the subscriber sees and feels about risk. Simply put, if two people went to the amusement park, they would have very different feelings when looking at a roller coaster that goes 110 miles an hour. One person can't wait to go on, while the other is looking for the carousel. But in the end, they will both be perfectly happy. The Fluid Risk Assessment Matrix allows all of your investments to be seen through that prism. So what's risky asset to one investor could be a not so risky asset to another. The Fluid Risk Assessment Matrix starts out with the lagging linear financial metrics that are normally associated with quantitatively measuring risk, but it doesn't stop there. It measures at a certain point in time the exact level of risk an asset holds when considering 10 additional geometrical data. Let's say the market loses 1%. Do you lose more money on a stock priced at $200 versus $20? Yes, $2 versus 20 cents. So which is riskier? Well, it's certainly a consideration, isn't it? Our matrix produces a risk score for each and every asset, either an individual stock, ETF, or mutual fund. And right now, we're beta testing a bond risk assessment matrix. The risk assessment score is a statement in time and has everything to do with the investor's risk tolerance, where one stock may be considered risky while it's conservative to another. What it does, it allows us to bring a higher level of efficiency into the portfolio. If we have a growth-oriented portfolio, we could actually place a triad of risk levels within that portfolio to make sure that every asset has the best opportunity for growth. Conversely, with this matrix, we can assuredly put together a portfolio that has growth, conservative, and somewhere in the middle. This risk assessment score allows us a disciplined process to choose great stocks, and it gives clients that all-important predictor to know when to buy, when to hold, and when to sell. When you become a subscriber, you'll receive a list of stocks that are in the portfolio of your choosing. Here is an example of a report we just sent out at the end of 2016. Reports are sent out quarterly and shows how the portfolio has performed year to date versus the S&P index. We also include an accumulation report that starts when you become a subscriber. Our reports also break down how each stock performed in the 10 stock portfolios. Please know that we have spent 2 decades researching, testing, and tweaking, and the one key to success in our portfolios is discipline on the investor's part, which means there's a temptation to hold on to assets that are doing well. If that stock is poised to do well in the next cycle, believe me, it will show up again in the next list. And trust me when I say this, it doesn't happen a lot. Discipline is important to take your profit by selling out of your position and then buying into a new one. Of course, we have a disclaimer, but I think it's more of a mutual understanding than a lot of fine print that only protects our interests. We will provide current lists of stocks that are in the subscribed portfolios. We do not offer financial or tax advice. We only provide information that you may or may not take action. We provide quarterly statements that pertain to the performance of our portfolios. These statements should in no way be a representation of your personal performance and shall in no way will we hold subscribers' assets nor have discretion over those assets. You, as the subscriber, have paid a subscription fee for 1, 2, or all 3 portfolios. Without direction from WealthShield as officers or employees, will decide to buy stocks listed in the subscribed portfolio, to sell these stocks, to buy or sell options on these stocks, or otherwise put capital at risk from these lists is the decision of you as the subscriber. Will hold assets away from WealthShield, its officers and employees in an appropriate account to minimize trading costs, have accurate accounting, and is easily accessible. Subscriber holds WealthShield and its employees harmless from any loss due to investing in these stocks. We would love to have you as a subscriber. If you have any questions or would like to schedule a personal presentation over the internet, please do not hesitate to contact our office Monday through Friday, 8 a.m. to 6 p.m. We offer a 100% money-back guarantee on all of our subscriptions. If you are not completely satisfied with our service for whatever reason, we will refund 100% of your subscription fees for that year. Upon subscribing, you will receive our subscription agreement via email. Once you agree to that, you will receive our current list of the portfolio you are subscribed to. We would like to thank you for your time in watching this presentation and hope we can help you soon.